Welcome to Hibiscus Petroleum's Financial Results Webcast. This webcast presents an overview of the results reported as part of our quarterly financial report for the 3-month period ended 31st December 2022 and released earlier today. This webcast has been prepared by Hibiscus Petroleum Berhad or the company solely for general information purposes and shall at all times be heard and or viewed together with the full quarterly report for the same period that has been made available or published by the company on its website. This webcast may contain forward-looking statements which are based on current expectations, beliefs, and projections about future events or matters. By listening to and or viewing the webcast, you agree to the limitations and notifications set out in the disclaimer section of this webcast. Our presentation today is split into 4 parts. Part 1 of our presentation presents our key messages and highlights for this quarter, which will be presented by Pascal Hoss, CEO of Hibiscus Oil and Gas Malaysia Limited, a wholly owned subsidiary of the group. Part 2 provides a brief outlook on the oil market, which will be presented by Lily Ling, our Senior General Manager of Corporate Development. Part 3 covers the group's quarterly operational and financial highlights, which will be presented by our VP of Economics and Business Planning, Deepak Thakur, and our Chief Financial Officer, Yip Chi Yong, or CY. Part 4 of our presentation covers guidance on our offtake schedule and gas sales, as well as an update on our reserves and resources. This will be presented by Deepak Thakur. Should you have any queries, you may contact our Investor Relations team, headed by Lily Ling, via the email address provided at the end of this presentation. Now, over to Pascal.
Hello, I am Pascal Hoss, CEO of Hibiscus Oil and Gas Malaysia Limited, and here are our key messages for the current quarter. Continued strong oil and gas prices have positively affected the group from a financial results perspective. In the current quarter, we sold approximately 1.3 million barrels of oil and condensate. Gas was also sold, which amounted to 0.7 million barrels of oil equivalent. In the first half of financial year 2023, we sold an aggregate of 3.5 million barrels of oil equivalent, comprising a total of 2.3 million barrels of oil and condensate and 1.2 million barrels of oil equivalent of gas. Going forward, the group's target for the 2023 financial year is to sell approximately 7.3 million barrels of oil equivalent of oil, condensate, and gas. In the current quarter, we delivered earnings before interest, taxes, depreciation, and amortization, or EBITDA, of 353.3 million ringgit and a profit after taxation, or PAT, of 70.5 million ringgit. The group's PAT in the current quarter was adversely impacted by a net deferred tax liability charge relating to the United Kingdom's Energy Profit Levy, or EPL, of 104 million ringgit. Additional details of this transaction or accounting entry will be illustrated in a later section of this webcast. At this stage, we wish to state that the significant net deferred tax liability recognized in relation to the EPL up to 31st December 2022 is non-cash in nature. The group reported a year-to-date PAT of 205.7 million ringgit. It was achieved after incorporating several adjustments which are one-off in nature and are not related to operations. Adjusting for these items, the group's year-to-date PAT would have been higher at 230.1 million ringgit. The nature of these adjustments will be elaborated later. The enhanced financial performance of the group has allowed us to reward loyal shareholders. Based on the present favorable market outlook and subject to the matters reflected in our dividend policy, the group is aiming to target a minimum total dividend per share of 2.5 sen over the course of FY 2023. Of this amount, an interim single-tier dividend of 0.75 sen has been declared on 16 February 2023. We have also obtained approval from shareholders for share buyback authorization and capital reduction on 1st December 2022. The proposed share buyback will enable the company to acquire its shares to capitalize any undervaluation, including, inter alia, the realization of potential capital gains if it later resells at higher prices. Overall, we are pleased with the progress and performance of the group. That's all from me. Now on to Lily with the oil market outlook.
Hello, I'm Lily Ling, Senior General Manager of Corporate Development at Hibiscus Petroleum. Moving on to part 2 of our presentation today, I will now provide a brief outlook on the oil market. Rystad Energy's outlook for liquid balances for calendar year 2023 indicate implied draws of 0.37 million barrels per day as they expect US production to be reduced by the December 2022 winter freeze and further rise of Russian supply with the rollout of the products ban in February 2023. Rystad also see signs of demand potentially remaining more resilient to the economic slowdown than previously forecasted. This chart shows Rystad Energy's oil price outlook under their base, bull, and bear cases. According to the analysis, Rystad estimate Brent prices to be in the range of $85 to $100 per barrel into calendar year 2023 under their base case, and see prices jumping towards $170 per barrel in their bull case. Overall, they maintain their view for $91 per barrel average oil in calendar year 2023 and $82 per barrel for calendar year 2024 as the market corrects towards equilibrium. China opening up is broadly positive for the global economy and oil demand as it eases bottlenecks in manufacturing and supply and restores oil demand in the top consuming country. As long as global GDP and demand growth remain uncertain, Rystad do not expect OPEC Plus to undertake material supply cuts or additions. In addition, Russia has changed course and appears to be using oil to stoke prices and aggravate the still ongoing energy crisis. On 10 February 2023, Russia announced that it would cut crude oil production by 500,000 barrels per day in March 2023 in response to the various international actions to set price caps and enforce embargoes. I will now hand over to Deepak, who will go over the operational highlights.
Hello, I am Deepak Thakur, VP of Economics and Business Planning. This table shows the operational performance of our North Sabah, Anasuria Cluster and Peninsula Hibiscus Group assets for the current quarter ended 31st of December 2022. Focusing on the North Sabah asset, the production facilities recorded an average uptime of 92%. This uptime achieved during the current quarter is marginally lower than that delivered for the preceding quarter. As a result, average gross oil production decreased marginally during the current quarter when compared to the preceding quarter, primarily attributable to prolonged periods of shutdown due to severe weather conditions. Average OPEX per barrel for North Sabah decreased to $18.50 as compared to the preceding quarter's OPEX per barrel of $20.57 as planned maintenance activities were conducted in the preceding quarter. A total of 538,301 barrels of oil net to sea hibiscus was sold at an average oil price of $98.09 per barrel in the current quarter, representing a decrease of 12.1% when compared to the preceding quarter's realized average oil price. Over at Anasuria, the average uptime and average daily oil equivalent production rate achieved at the Anasuria cluster for the current quarter of 92% and 3,009 barrel of oil equivalent per day, respectively, are higher than that recorded in the preceding quarter. This is due to the completion of riser replacement project in the preceding quarter, which enhanced Anasuria's current quarter production. One crude oil offtake was conducted at Anasuria during the current quarter, in which 185,869 barrels of oil net to Anasuria Hibiscus UK was sold at an average realized oil price at $82.56 per barrel. The average OPEX per BOE achieved in the Anasuria cluster for the current quarter of $18.67 is marked improvement from the $37.02 per BOE recorded in the preceding quarter, as production improved upon successful completion of the project to replace a failed riser in the preceding quarter. The Peninsula Hibiscus Group assets include the 2012 Kinabalu Oil PSC, PM3 CAA PSC, PM305 PSC, PM314 PSC, and Block 46 PSC. The Kinabalu and PM3 CAA assets are the largest contributors to the Peninsula Hibiscus Group's performance. Over at the Kinabalu asset, there was an increase in the average net oil production in the current quarter compared to the preceding quarter, with the conclusion of the planned annual major maintenance campaign in the preceding quarter. Kinabalu's average net oil production of 3,160 barrels per day accounted for over 50% of Peninsula Hibiscus Group's total average net oil and condensate production of 6,188 barrels per day. Average OPEX per barrel decreased to $17.81 when compared to $21.39 in the preceding quarter, mainly due to the increase in production. At PM3CAA, average net oil and condensate production increased in the current quarter as a result of several factors, including the planned annual major maintenance campaign, which was completed in the preceding quarter, better performance from PM3 Northern Field gas injection compressor supplying gas lift to the oil producers, and successful completion of BKC-10 STL perforation in the oil zone. PM3CAA's average net oil and condensate production of 2,701 barrels per day accounted for approximately 44% of Peninsula Hibiscus Group's total average net oil and condensate production of 6,188 barrels per day. Average gross sales production increased by 22% in the current quarter due to the planned annual major maintenance campaign in the preceding quarter. Average OPEX per BOE decreased to $14.68 as compared to that achieved in the preceding quarter's OPEX of $18.03 per BOE, primarily due to the increased production in the current quarter. I will now pass it on to CY to bring you through the financial highlights.
Hi, I'm CY, the Chief Financial Officer of Hibiscus Petroleum Group. I will now take you through an overview of the financial highlights for the current quarter. Before I go into the details, I wish to elaborate on one of the opening remarks made by Pascal earlier regarding the group's PAT. The group's PAT in both the second and the first financial quarters of the current financial year included several adjustments that were deemed to be one-off and not related to operations. The first of these adjustments is a one-off net deferred tax liability charge relating to the UK EPL. As dictated by the relevant UK laws and accounting standards requirements on EPL, the charge was computed out of the carrying values of the intangible and oil and gas assets at the point when the EPL regime became effective, that is on 26 May 2022, and the changes to the EPL regime that became effective on 1st Jan 2023. This resulted in a one-off, non-cash adjustment of 99.1 million ringgit. Secondly, during the current quarter, the group's subsidiaries, Hibiscus Oil and Gas Malaysia Limited and Hibiscus Oil and Gas Malaysia PM3 Limited, reversed an over-provision of taxes and related penalties relating to the Petroleum Income Tax Act 1967 or PITA and the Corporate Income Tax Act 1967 or CITA, which amounted to 67.5 million ringgit. This adjustment followed a reassessment of the related provisions subsequent to the completion of tax audits for certain years of assessments. The final adjustment, as shown in this slide, relates to the Block 46 PSC in Vietnam. The adjustment was on the accounting treatment of crude oil inventory balance of 81,000 barrels, acquired from the Repsol Group on 24th January 2022. After omitting the impact of all three adjustments, the group's normalized PAT for the current quarter increased from the reported 70.5 million ringgit to 115.4 million ringgit, whilst the year-to-date PAT would have been higher at 230.1 million ringgit instead of the 205.7 million ringgit reported. In addition, the normalized tax rate of 42.3% is close to the statutory tax and levy rates. As often reiterated in the past, we practice careful management of costs and the efficient delivery of production enhancement projects. This continues to be a critical part of our strategy of maintaining a low unit production cost structure in our producing assets. We also time the implementation of maintenance activities to ensure that positive cash flows are consistently delivered. The group operates or jointly operates its main producing assets, which is a key enabler in allowing us to influence the timing of the implementation of operational activities, supporting our ability to manage the phasing of expenditure. The charts on this slide show the quarterly average realized oil prices, unit production costs, and EBITDA margins for both the Anasura cluster and North Sabah over the last 10 quarters. For the Peninsular Hibiscus Group assets, the chart shows the weighted average realized prices of both oil and condensate offtakes and gas sales, unit production costs, and EBITDA margins over the last 4 quarters.
As clearly shown in the charts, the average unit production costs for the Anasuria cluster, North Sabah, and the Peninsular Hibiscus Group assets are all well below the average realized oil price achieved in the respective quarters, delivering sustained positive cash flows. Management's focus remains on continuing this trend of overall performance. The group's revenue is almost fully transacted in US dollars, while costs are mainly denominated in the local currencies of the jurisdictions in which the operating assets are located, namely the Malaysian ringgit in Malaysia and the British pound in the UK. In addition to that, some costs are denominated in US dollars. Accordingly, a healthy US dollar bodes well for the group and positively impacts our cash flow and financial performance. The group's financial performance in the current quarter remains strong on the back of high oil, condensate and gas prices and good operational performance. The group recorded a revenue of 713.1 million ringgit for the current quarter. Via its producing assets, the group sold approximately 1.3 million barrels of crude oil and 650,000 barrels of oil equivalent gas. The sale of oil and condensate contributed 605.3 million ringgit to total revenue, while contribution from the sale of gas was 106.8 million ringgit. The relatively strong oil, condensate and gas price levels have contributed positively to the profitability levels in all the group's producing assets in Malaysia and the United Kingdom. The average realized oils and condensate prices achieved by the group in the current quarter was over $96 per barrel. This favorable price level, coupled with good operational performance, have been key drivers of our business performance and have enabled the group to report a strong EBITDA for the current quarter of 353.3 million ringgit. The Peninsular Hibiscus Group assets, which were acquired from the Repsol Group in January 2022, continue to contribute positively to the financial performance of the group. During the current quarter, this Peninsular Hibiscus Group assets contributed 375 million ringgit or 52.6% to the group's revenue, 194.5 million ringgit or 55.1% to the group's EBITDA, and 119.6 million ringgit or 169.7% to the group's PAT. I'll now highlight the contribution from the two notable production sharing contracts in the Peninsular Hibiscus Group assets on the group's financial performance, namely the PM3 CAA PSC and the Kinabalu PSC. Both these PSCs experienced high production levels subsequent to the completion of the planned major maintenance campaign for calendar year 2022 in the preceding quarter. Besides that, the production level in PM3 was enhanced by improved performance from the PM3 Northern Field Gas Injection Compressor, supplying gas lift to the oil producers, and the successful completion of the BKC-10 STL perforation program of the oil zone, which resulted in incremental gross production of approximately 1,200 barrels per day. Gas revenue and oil revenue from the PM3 CAA PSC achieved in the current quarter were 80.5 million ringgit and 77.1 million ringgit respectively. In addition to the 188,000 barrels of oil and condensate sold at an average oil price of $90.34 per barrel, 628,000 barrels of oil equivalent gas was sold. In the current quarter, PM3CA attained gross profit amounting to 83.2 million ringgit, and the gross profit margin was at a healthy 52.8%. The EBITDA for PM3CA was 100 million ringgit, which resulted in an EBITDA margin of 63.4%. PM3CA achieved an average uptime of 91% and an average net oil and condensate production rate of 8,790 barrel of oil equivalent per day, while a low OPEX per BOE of $14.68 was recorded. The next notable production sharing contract in the Peninsular Hibiscus Group assets is the Kinabalu PSC. This PSC sold 288,000 barrels of crude oil net to our group at an average oil price of $106.83 per barrel. Kinabalu achieved gross profit of 90.2 million ringgit and a relatively high gross profit margin of 64.6% in the current quarter. The high profitability was due to the high average realized oil price achieved. Kinabalu's EBITDA for the current quarter amounted to 54.3 million ringgit. The EBITDA margin over revenue of 139.7 million ringgit was 38.9%. The average uptime in the current quarter improved to 86% due to the completion of the annual planned major maintenance campaign in the preceding quarter, during which the production facilities were shut down for 11 days. Accordingly, the average net oil production rate recorded in Kinabalu was high at 3,160 barrels per day, while OPEX per barrel was relatively low at $17.81 per barrel. I would like to highlight that while the Kinabalu PSC was in a taxable position in the current quarter, no provision for taxation was made, as there were sufficient historical tax losses brought forward to completely offset such taxes payable under the PITA. Moving on to the North Sabah asset. This segment recorded revenue and gross profit of 239.5 million ringgit and 151.7 million ringgit respectively. The asset sold 538,000 barrels of crude oil net to the group. These barrels were sold at an average oil price of $98.09 per barrel, while North Sabah's average OPEX per barrel was $18.50 per barrel. The average uptime achieved in the current quarter was 92%, while the average net oil production rate was 4,626 barrels per day. In the current quarter, the average net oil production rate was adversely impacted by higher unplanned, prolonged shutdown due to severe weather conditions. This partly offset the more stable operating conditions experienced during the current quarter subsequent to the completion of the annual planned major maintenance campaign for calendar year 2022 in August 2022. A high average realized oil price, coupled with careful management of cost and efficient operational performance, resulted in an EBITDA margin attained in the current quarter of 40.1%. As for the United Kingdom, operational performance in the current quarter improved significantly following the completion in the preceding quarter of the project to replace the riser which malfunctioned in May 2021. Following the failure, the riser, which transports produced crude oil from the subsea well to the Anasurya FPSO, was temporarily isolated from the primary production system, and the impact of that temporary isolation was a lower overall daily production rate from the Anasurya cluster that adversely affected OPEX per BOE and offtake volumes. The riser returned to service in September 2022 and resulted in production levels in the current quarter to double that in the preceding quarter. This metric rose from 1,468 BOE per day in the preceding quarter to 3,009 BOE per day in the current quarter. In addition, we are pleased to highlight that the average uptime achieved by the Anasurya cluster was high at 92%, while the average OPEX per BOE dropped to below the $20 mark for the first time since the financial quarter ended 31st of March 2021 at $18.67. The UK segment's EBITDA recorded in the current quarter stood at 66.7 million ringgit. Its results after taxation were however heavily impacted by the effects of incorporating the non-cash effects of the new EPL regime up to 31st December 2022, as dictated by the relevant UK laws and accounting standards requirements. The resulting outcome was a significant net deferred tax liability charge in the current quarter of 104 million ringgit. As a background, the EPL took effect from 26 May 2022. On 17 November 2022, the UK government announced changes to the EPL regime effective from 1 January 2023. The revised EPL regime includes an increased levy rate of 35%, from 25% on United Kingdom oil and gas profits, on top of the existing ring-fence corporation tax of 30% and a supplementary charge of 10%. This will mean that the UK upstream oil and gas industry will face a 75% marginal rate of tax. The enhanced deduction for certain categories of capital expenditure to offset against taxable EPL income will be reduced to 129%, except in the case of decarbonisation expenditures, which will retain the 180% enhanced deduction. Despite it being a tax on windfall profits, the UK government stated that they do not intend on phasing out the EPL, even if oil and gas price levels move back to more normal levels. The changes to the EPL regime were substantively enacted on 30th November 2022, and accordingly, the effects arising from these changes which took effect from 1st January 2023, are required to be recognised by Anasuria Hibiscus UK on 30th November 2022. The EPL is regarded as an income tax, similar in nature to the ring-fence corporation tax and the supplementary charge, and therefore falls within the scope of International Accounting Standard 12 for income taxes. Accordingly, temporary differences that arise from the EPL regime should be accounted for deferred tax in the same way as the ring-fence corporation tax and the supplementary charge. The deferred tax liability arising from the EPL regime as at 31st December 2022 was based on the taxable temporary differences expected to reverse during the window for which the EPL regime applies, up to 31st March 2028. These temporary differences arose from the expected future amortization of intangible assets and depreciation of oil and gas assets, up to 31st March 2028, and are computed out of the carrying values of the intangible and oil and gas assets at the point when the EPL regime became effective. That is on 26 May 2022, and the changes to the EPL regime that became effective on 1st January 2023. Subsequent to a full reassessment exercise in December 2022 relating to the EPL, the net additional deferred tax liability that is required to be recognised in the current quarter amounted to 104 million ringgit. To reiterate, such net deferred tax liability relating to the EPL, recognised as at 31st December 2022, is non-cash in nature and will be fully reversed to the profit or loss by 31st March 2028. It should be noted that we do not expect a significant income taxation liability arising from the EPL regime. Our intention remains to phase our UK capital expenditure program such that we optimise the incentives offered as part of the EPL being imposed. It is also clear that the government is incentivising decarbonisation initiatives within the UK oil and gas sector, and this encourages us to identify further opportunities that will reduce our overall carbon footprint. Despite this largely one-off in nature charge, the group managed to report a PAT of 70.5 million ringgit in the current quarter due to its strong operational performance. In addition to the group's strong financial performance derived from its operations, the above-mentioned tax-related negative impact in the United Kingdom was partly offset by a reversal of over-provision of taxes in the group's Malaysian operations of 67.5 million ringgit. During the current quarter, tax audits performed by the Inland Revenue Board of Malaysia on Peninsular Hibiscus subsidiaries, namely Hibiscus Oil and Gas Malaysia Limited and Hibiscus Oil and Gas Malaysia PM3 Limited, for certain years of assessments were completed. These audits covered the tax regimes under PITA and SITA. The additional tax amounts assessed by the Inland Revenue Board of Malaysia were lower than the provisions previously made by 67.5 million ringgit and has been duly recognised as a gain by the group in the current quarter. Lastly, the group returned to a net current assets position of 197.5 million ringgit as at 31st December 2022, as opposed to the net current liabilities positions reported for the 3 financial quarters subsequent to incorporating the impact which arose from the acquisition of the entire equity interest in Fortuna International Petroleum Corporation from Repsol on 24th January 2022. The improved financial performance and positive cash flows from our producing assets have contributed to this positive turnaround. At this stage, I will provide some insights into the group's current quarter's financial performance when compared to what was reported for the preceding quarter, ended 30th September 2022. Revenue in the current quarter of 713.1 million ringgit increased by 18% or 108.4 million ringgit when compared to the preceding quarter's 604.8 million ringgit. This was due to higher volume of high oil and condensate sold in the current quarter, which offset the lower average realized selling prices achieved. A total of 1.3 million barrels of oil and condensate and over 650,000 barrels of oil equivalent of gas were sold in the current quarter, higher than the 1 million barrels of oil and condensate and over 510,000 barrels of oil equivalent of gas sold in the preceding quarter. The average realized oil price and condensate prices achieved by the group in the current quarter of over $96 per barrel, though high, was lower than the preceding quarter's $111. In comparison to the preceding quarter, the group's operational performance has greatly improved. In the United Kingdom, operational performance in the current quarter improved significantly following the completion of the riser replacement project in the preceding quarter to replace the riser which malfunctioned in May 2021. Production levels in the current quarter doubled when compared to the preceding quarter. The group's operational performance was further enhanced by improved performance from the PM3 Northern Field Gas Injection Compressor supplying gas lift to the oil producers and the successful completion of the BKC-10 STL perforation program of the oil zone. Average OPEX per BOE of the group decreased to $16.42 as compared to the preceding quarter's OPEX per BOE of $20.51. The group's average net oil, condensate and gas production rate achieved for the current quarter of 19,912 BOE per day was higher than that recorded in the preceding quarter of 16,775 BOE per day. In the current quarter, the group achieved an EBITDA of 353.3 million ringgit. This represents an increase of 54.9 million ringgit or 18% in comparison to the EBITDA in the preceding quarter of 298.4 million ringgit. Both quarters' results had been positively impacted by reversals of overprovision of taxation and penalties in its Malaysian operations. In the current quarter, as mentioned earlier, there was a reversal of an overprovision of taxation and penalties of 67.5 million ringgit in aggregate for the 2017 year assessment for PITA and for the years of assessment from 2017 to 2019 for SITA. Whereas for the preceding quarter, there was a reversal of an overprovision of taxation for 2021 year of assessment for PITA, amounting to 40.2 million ringgit, upon finalizing the submission of tax return to the Inland Revenue Board of Malaysia. At the results after taxation level, however, the current quarter's PAT was significantly impacted by the recently announced changes to the EPL regime. These results resulted in a non-cash net deferred tax liability being incurred amounting to 104 million ringgit relating to the EPL was charged, as illustrated earlier. I will now hand over back to Deepak, who will go over the offtake schedule and an update on our reserves and resources.
Hello again. This slide presents the group's financial year-to-date oil and condensate offtakes and gas sales from our producing assets, together with the latest estimates for the financial quarter ending 31st of March 2023, as well as the financial quarter ending 30th of June 2023. During these periods, we estimate to sell a total of approximately 1.8 million barrels of oil equivalent and 2.0 million barrels of oil equivalent of oil, condensate and gas respectively net to the group. For the financial year ending 30th of June 2023, the group is targeting to sell a total of approximately 7.3 million barrels of oil equivalent of oil, condensate and gas. Moving on to the following slide. The chart on this slide depicts our updated net oil and gas reserves and resources as at 1st January 2023 across all our assets. As of 1st January 2023, our total net proven and probable or 2P reserves stood at 68.8 million barrels of oil equivalent, whilst net 2C contingent oil resources stood at 72 million barrels. I will now hand over back to Andrew.
Thank you, Deepak. And that is all we have for this quarter's earnings webcast. Thank you for tuning in.